do not pull your investments. The second people see market downturn, they immediately want to sell, pull all of their money out of the market and pull their investments. If you pull your investments, you're just going to lock in the existing losses rather than giving your portfolio a chance to go up again. A really great example of this was COVID. Back in March of 2020, we saw the stock market plummet. And the folks who got scared and pulled their money locked in those losses. However, if you were smart and just stayed the course, August of 2020, all of those losses would have been made up. And then over the past 5 years, we actually saw the market reach its newest highs. You would have just made money. In fact, when the stock market is down, you can think of it like a sale. Nobody runs from a sale at a department store. Why would you run from a sale in the stock market?
That's easier said than done, right? See, the reality is the vast majority of investors are going to be some combination of reason and emotion. That's going to be dependent upon what's going on at the time, right? At least in my experience over the course of the past 30 years, helping business owners really figure out their financial life and manage their resources towards goals that matter. My experience is that when things get volatile, people tend to get a little bit more emotional with regard to their nest egg. And I understand why, but it's more than just emotion and reason that impacts things. It's also circumstances. As an example, you have something called sequence of return risk. This is the type of risk that matters when you don't know what types of returns you're going to experience up until the point when you need access to your capital, right? Because the only thing I can guarantee about the markets, whatever market we're talking about, is that it will go up and it will go down. It's volatility that's just inherent in every climate. But like as an example, let's say you're getting ready to retire. It is absolutely reasonable to be concerned if the market takes a sudden downturn at that point, because that's the moment in time you may be tapping into your resources in order to supplement your income needs. Whereas if you're just getting started with investing and your time horizon is 30, 40, 50 years or more, well, what's happening in the moment right now is probably not as impactful over the lifespan, if you will, of your investing time horizon. So when you're trying to figure out what strategies and how to really incorporate the reality of what's going on in the market at any given time into your life and in your approach to things, you want to sit down with a knowledgeable advisor. But the whole point is to really elevate your financial literacy so you can make fully informed decisions. And one of the good ways of doing that is simply just to jump around all of the other free content that I have on here.